Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
Now, granted, if it's very bearish and the index just gets clobbered, great, no problem. But the truth is, this one is more of a not bullish strategy than it is a bearish strategy. But the reason but because of that, that's why I can only make $780. Maximum loss is a lot higher on this, though. The maximum loss is $2,220, but look where that maximum loss is at. It's at 128. That means that this index has to rise sharply in order for you to hit the max loss zone. And that's not to say it couldn't happen, because frankly, just a few weeks ago, it was at that level. But it does have to go quite a bit in the wrong direction in order for you to hit the max loss zone. Whereas in the other one, it actually doesn't have to go nearly as much, and you'll hit the max loss zone. So even though you are risking $2,220 to make only $780, it's pretty easy to see that the odds of actually hitting that max profit are quite a bit higher than the odds of hitting that max loss. All right, now let's take a look at a couple of more interesting trades. Now, those are pretty simple, straightforward, two-legged vertical spreads. Most people have no problem with those, and they're pretty easy to understand. Let's take a look at two other ways that you can capitalize on a bearish bias, or in this case, you can hedge the downside movement of the dollar versus a foreign currency. The first one is a put ratio spread. Now, ratio spread is kind of interesting because even though we call it a spread, the reality is your entire position is not really spread. In this example, I'm going to buy 10 puts, but I'm going to sell 20. What I've really got here is a 10 by 10 spread, and I've also got 10 naked options. So even though we call this a spread, the margin requirements are going to be quite a bit higher because this particular strategy involves partially having naked options. But we call it a ratio spread because the portion of your position that's naked is exactly the same contract as the part that's spread. So in a sense, you've got only two different strike prices working here. So let's look at the first example. It's an in-the-money put ratio spread. This one is slightly bullish to neutral. But it's an interesting kind of strategy, and if you look at the generic profit and loss chart, you can kind of see that this one has a profit zone that's in a spot between two loss zones. Now, granted, the loss zone to the upside is quite small. As you can see, that red band going off to the right is very, very thin, so the amount you lose if you're completely wrong and the index goes higher is quite small. But the trade-off for that, having a loss zone on the top and the bottom, is that when you hit the target, which is that green triangle, you can actually put a pretty nice profit up, and your initial cash outlay on this trade is pretty small, which is one of the nice things about it. So the way this works is I'm going to buy 10 of the $79 puts, and then I'm going to sell twice as many of the $77 puts. And I'm using the euro here, which is the dollar relative to the euro, as my example. So I buy 10 of the $79 puts. Those cost me $360. I sell 20 of the 77 puts. Those are further out of the money, so they're a lot cheaper. But because I'm selling twice as many, the amount that I bring in almost covers the entire cost of the long leg, and I end up with a net debit on this one of only 20 cents, which on a 10 by 10, that's that's only $200. It's pretty small, very, very small. Now, to calculate the break-evens, they're a little bit tricky because we've got two of them, as you can see in the graph below. You've got to break even to the upside, and you got to break even to the downside. And ideally, what you want to do is fall somewhere in between the two. So your upper break even is calculated as your short strike price minus your max gain, and your lower or your upper break even is your long strike price minus your debit. So that puts our break even prices at $75.20 and $78.80. Your maximum gain here is going to occur at 77, which of course, based on the chart, that's right at the top of that point. This is one of those trades where you're probably not going to hit your max gain, kind of like a butterfly if you're familiar with those. When max gain occurs at only a single price, the odds of hitting it are very, very small. You know how hard it is to predict where this index might be on expiration, whether it's going to be higher or lower, but you actually have to predict not only whether it's going to be higher or lower, but exactly what price is going to hit exactly at 4 o'clock on closing, when the market closes on expiration date, in order to hit that max profit. Not likely. But the good thing is you've got a pretty wide range, and you can see here if you've calculated your upper and lower break-evens of $75.20 and $78.80, then that means that anything between those two numbers is a profit zone. That's a pretty wide zone, and that's that whole green area. And ideally, that's all you're trying to do is get in that green zone. Now, remember, you're bearish on this trade, but you're only moderately bearish. If this particular index happens to fall off a cliff and really get annihilated, you'll actually blow all the way through your profit zone and end up in a pretty sizable loss zone to the downside. So your max loss to the downside is actually unlimited. Well, I shouldn't say it's unlimited, but you've got exposure all the way to zero, and you could lose a lot of money on this one, $75,000. It's a big loss, but you got to have a pretty significant move in order to get into the loss zone to begin with, and you'd have to have it virtually go to zero in order for you to lose that amount. So not real likely to occur. To the upside, it's pretty small. As I said, the upper max loss is calculated as just the total amount of your initial debit, and that's your 20 cents, so your $200, and that's going to occur anytime it's above the upper strike price of 79. So let's take a look at this one, and then, well, let me go ahead and mention the second one first, then we'll go look at the chart. My second example is one where you're very bearish. If you were very bearish on your first trade and you did it, you'd end up in that red zone, and that wouldn't work out so well. So it'd be aggravating to be bearish and have it be too bearish, and you'd end up losing money. If you're a lot more bearish and you're concerned that you're going to end up too far down and go into that red zone, then you just got to adjust your strike prices down. So instead of using the 79 and 77, we move them down to 75 and 73. That means that we set our target zone at a much lower level. So if I'm more bearish and I believe this index has the ability to fall a lot more, then I just simply move that green triangle down in price a bit. So let's take a look at these on the chart. So first, the orange trade. Remember, my lower break even is at 75.20, and 75.20 you can see below is the bottom edge of that orange zone that I've drawn in on the chart. My upper break even is 78.80, which is the top edge of that orange zone that I've drawn in on the chart. And ideally, our perfect spot to get to is exactly at 77, which is my maximum gain. And what I did was I drew in a green line there, right in the middle of that orange zone. That's your target. Now you're hitting a target, and you're hitting a moving target, and you're just trying to get as close to that target as you can, but you know you're not going to hit it exactly. So you want to target that green line, but if you fall anywhere around that green line and it's within that orange zone, that's a profit zone. Now if you end up too high because this thing goes completely the wrong direction, then you're going to hit your max loss to the upside, which occurs above 79. I don't have 79 drawn in here, but you can see that it's just a smidge above the top of that orange zone, since the top of that orange zone is 78.80. So if this index completely recovers back to the levels it was in June, then you're probably not going to make any money, but you're going to only lose $200. No big deal. Your danger here is if the thing falls too far. Now, you're actually in a position right now at 75.58 where you're a little on the low end. Right, your target zone here, remember, is 75.20 to 78.80, and you're actually at 75.58. So I've got this listed as a bearish strategy, but in reality, because of the strike prices I chose, this trade actually ends up being slightly bullish to neutral, because if you're trying to target 77, what you'd actually have happen is you want this index to come up a little bit from its 75.58 zone to about 77, or where that green line is. So you're actually in the profit zone right now, and ideally you really don't want this thing to go any lower. You want it to kind of stay in that zone and maybe even pick up just a little bit. Now if you're a lot more bearish than that, try using the one in the yellow zone. This is a 75-73 ratio spread. This trade is also done for exactly the same price, 20 cents debit. Quite interesting, huh? Two completely different zones where I want this particular index to potentially end up, and I can target them both, but unlike the single two-legged spreads that I was just talking about, I can do either of these for around the same price. So the most important thing here is not how much money this thing costs you or what your gain to loss ratio is or anything else. It's about being able to forecast where do you think this index is going to be at expiration.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.